Welcome to the deep dive. Today, we're skipping the high-level theory and getting right into, well, the structural engineering of making money systematically.
That's right.
We're focusing on Forex algorithmic trading. But specifically, look, it's not just about coding any bot. It's about finding those non-negotiable rules, the essential tools, and the actual systematic process you need for consistent profit.
Yeah, and that's really the key, isn't it? Because this is where most people, most aspiring algo traders, they just crash and burn. They have an idea, but they mistake that for a proven process.
Right.
And if you're serious about automating trading, these implementation details, well, they're pretty much the whole game. You've got to grasp the systematic approach for, real-world survival.
And just to set the scene, the scale of this market, it's huge.
Oh, it's overwhelming. Absolutely. Think about this. By 2024, something like 92% of all Forex trading was already done by algorithms. Yeah. So that statistic alone tells you winning isn't about finding some secret magic indicator. It's about perfecting your process so it's more robust, more rigorous than, well, everybody else's machine.
Okay. Let's unpack that. So we're talking computer programs making trades way faster than humans based on rules we set.
Yeah.
But in a market that automated, what kinds of strategies are, actually robust enough for someone at the retail level to even consider?
Well, we've seen three broad categories that tend to hold up consistently if they're managed correctly, of course. That's the big caveat.
Okay, let's start with movement. What's strategy number one? The one that assumes prices keep going the way they're going.
That's momentum trading. Pretty simple premise, really. Prices tend to continue in their current direction, so an algorithm would automate finding that trend, maybe using moving averages, something standard, and then it specifically looks for, temporary pullbacks.
Ah.
So, for instance, the algo might only trigger a buy entry if the market's clearly trending up, but the RSI, the relative strength index, dips below 30. That suggests, a brief temporary oversold moment within that bigger uptrend. You're basically automating that disciplined by the dip rule.
Got it. Riding the wave. So what's the opposite bet? The strategy that expects the wave to kind of snap back.
Yeah, that would be mean reversion. Yeah, this one works on the assumption that when a price moves, too far from its historical average, it's statistically more likely to head back towards it. So here the algorithm is specifically hunting for those extremes, overbought, oversold conditions, maybe using oscillators like the stochastic or RSI again. But this time it's looking to initiate trades against the recent move, countertrend.
Makes sense.
Yeah.
And the third one, the one that sounds a bit more statistically involved, exploiting temporary glitches.
Right, that's statistical arbitrage. Often this is done through what's called pairs trading. So you find two currency pairs, let's say EURUSD and GBP/USD, that usually move together. They're highly correlated historically. Now, if that relationship temporarily breaks down, maybe one pair jumps up while the other just sits there, the algorithm trades both simultaneously. It might short the one that jumped and long the one that lagged, betting on that historical price relationship snapping back into line.
Okay.
It's basically exploiting those little fleeting market inefficiencies.
So having the strategy idea, that's one thing. But you said earlier the implementation, that's the hard part. And the big killer here is overfitting.
Overfitting. Yeah, it's the definition of fool's gold in this game. It means you've accidentally built a strategy that looks, well, perfect on your historical test data. Absolutely flawless.
Sounds good so far.
Hey, right. But that perfection comes from basically memorizing the random noise and the specific quirks of that past data, not from learning a real repeatable market pattern. So the moment you put it live, poof, it fails.
Ah.
To beat that, you need a process, like a really strict, almost military-grade process.
Okay, so our sources map out 4 critical steps for that process. Step 1 is getting the data right. Sounds simple, but what's the main pitfall just with the data itself?
Well, it's more than just getting clean data. You need high-quality historical data, and we're talking a decent amount, at least 2, maybe 3 years minimum. And critically, it has to cover multiple currency pairs and timeframes, not just one.
Multiple pairs, okay.
And this is crucial, the data must include different market conditions. You need periods where the market was strongly trending, periods where it was just chopping sideways, times of high volatility, and, quiet periods too.
Why is that so important?
Because if you only test, say, your mean reversion strategy on data where the market was always range-bound, it'll look amazing. But the second a strong trend kicks in live, it's going to get absolutely destroyed.
Right, it hasn't been tested for that reality.
Yeah.
Okay, so data is the foundation. Step 2, rigorous backtesting. But isn't backtesting just Well, making it look good on old data, what makes it rigorous versus just hitting play?
That's the absolute core distinction. To stop yourself from overfitting, you must use walk-forward analysis, or WFA. Honestly, this is the key thing separating hobbyists from pros.
Walk forward analysis. Okay.
What you do is you optimize your strategy's parameters on one chunk of historical data. That's your in-sample data. Then you immediately test those exact parameters on the next chunk of data the strategy has never seen before. That's the out-of-sample test.
I see.
Then you slide the window forward. The old out-of-sample becomes part of the new in-sample. You re-optimize, test on the next new out-of-sample chunk, and repeat. Roll forward, step by step.
And if it fails on that never-seen-before data?
You scrap it or significantly rethink it. If it only performs well on the data it was optimized on, it's probably overfit. WFA confirms if it has any predictive edge on unseen data.
Okay, that sounds like a lot of work. Manually.
Mhm.
Or are there tools for this? What should someone look for in a platform?
Oh, definitely not manual if you want robust results. You really need specialized software platforms. Tools like Strategy QuantX, for example, are built for this. They integrate these robustness checks automatically.
Right.
Things like genetic optimization, but critically, that walk-forward and out-of-sample testing framework. It has to be built in, otherwise it's too easy to, well, fool yourself.
Right. So let's say our strategy actually survives this walk-forward gauntlet. Step 3 is forward testing. Why bother with a demo account if the back test, the rigorous one, looks good?
Because even the best backtest still lives in a kind of perfect simulation. Step 3, forward testing on a demo account, running it in real time for, say, at least 4 to 6 weeks. That's your reality check.
There's a catch.
It catches the real-world friction, things like actual execution latency, the delay between your signal and the trade happening, unexpected slippage, especially when news hits and spreads widen, even simple things like hiccups in the data feed from your broker.
Yeah.
If the algo can't handle live market dynamics smoothly, even without real money on the line, it's not ready.
Okay, makes sense. Reality check complete, it survives demo. Step 4, going live carefully. What are the key rules for that initial deployment?
Careful live implementation. And careful means starting tiny, really small position sizes. Monitor its performance like a hawk. And, critically, you must have a predefined shutdown rule before you start.
A shutdown rule.
Yeah, you decide up front what's the maximum acceptable drawdown. Maybe it's 10% of the capital allocated to that strategy. You decide that before the first live trade. If the strategy hits that loss level, boom, you pause it. Stop trading. Go back and reevaluate what's going wrong. You absolutely cannot let losses just spiral out of control hoping it turns around.
That discipline, those predefined limits,
Yeah.
that ties right into managing the ongoing risks, doesn't it? Like model risk. If a strategy works now, won't it just keep working?
That's the dream, but unfortunately that's the core of model risk. See, your model, your strategy, it's built based on patterns observed in the past. But markets evolve, right?
Yeah.
Especially now with, geopolitical stuff. Big shifts in central bank policy. Things change. So yes, some periodic reoptimization might be necessary. But, and this is a big but, you have to guard against over-optimization. That constant nervous fiddling with the parameters every time you have a losing trade, that just destroys consistency.
Like tuning your car engine every time you hit a speed bump.
Exactly. Yeah, sometimes the road surface changes fundamentally and you need an adjustment. But mostly, you just need to let the suspension do its job. Don't tweak constantly.
Got it. And another risk people mention is survivorship biases. How does that apply to Forex pairs?
That's a really sneaky hidden trap. If you build and test your strategy only using the currency pairs that are actively traded today, the big ones like USD, GBD, GB, JB, Y, etc., you're completely ignoring any pairs that might have existed 10 years ago but got delisted, or maybe merged, or just faded away because they weren't liquid enough. By testing only on the survivors, you're ignoring all those historical failures. And that gives you an overly rosy and frankly dangerously incomplete picture of how your strategy might actually perform over the long haul across the whole market.
Okay, that makes sense. What about costs? The things that chip away at profits?
Right, eroding costs. These are the silent killers: spreads, commissions, slippage. They seem small on each trade, but they can absolutely wipe out whatever small edge your algorithm might have.
So you have to factor them in.
You must test using realistic, maybe even slightly pessimistic cost assumptions. I remember one case, a client had this beautiful backtest, looked fantastic, but the live results were consistently negative. Why? They hadn't factored in how much the spreads widened during major news events. That friction just ate all the profit. You have to account for it.
And then there are the technical gremlins. Boring, maybe, but potentially disastrous.
Oh, yeah. Technical failures, these are non-negotiable risks you have to mitigate. Network connection dropping out, your trading platform crashing, even just a slow data feed messing up your entry timing.
So what's the fix?
The fix is basically mandatory for serious algo trading. Use a reliable Forex virtual private server, a VPS.
A VPS, okay.
Yeah. It's a remote computer running 24/7, usually located physically close to your broker's servers. It minimizes that latency issue, ensures your algorithm is running constantly, even if your home internet goes down, and it just provides that essential layer of technical stability. Backup systems are key too.
But okay, even if you've got the perfect algorithm running on a top-tier VPS, shielded from technical glitches,
Yeah.
the human element is still there, right? If it's automated, why is psychology still such a hurdle?
Because you are still managing the overall strategy portfolio.
Yeah.
The machine executes, yes, but the human decides when to start it, when to stop it, how much capital to give it, and those psychological demons, they persist.
That's so.
Well, you're still watching the equity curve. You see those drawdowns happening in real time, and that primal urge kicks in the temptation to, tweak the system just a little bit during a losing streak. Or worse, maybe you get a gut feeling you know the market's about to turn, so you manually override the system.
Ah, the I know better trap.
Exactly. I saw a really sophisticated strategy, well-tested, lose about 30% of its capital in just 1 week. Why? Because the trader got nervous during some choppy price action, convinced he knew better than the rules he himself had set, and manually disabled that predefined shutdown rule.
Ouch.
Yeah. Real success here means having the discipline to stick rigidly to the rules you defined when you were thinking clearly and objectively before the emotions of live trading kicked in.
So, painting a picture of success then, what do the traders who actually achieve consistency do? What are their common traits?
Well, first off, they absolutely prioritize diversification. They get that no single magic algorithm works perfectly all the time in all markets.
So they run multiple systems.
Exactly. Multiple strategies, often across different currency pairs, maybe even different time frames. The idea is, if their mean reversion strategy is getting chopped up during a strong trend, hopefully their momentum strategy is catching that trend and helps balance things out.
And risk management. You mentioned the 1-2% rule.
That's bedrock. It has to be absolute. They never risk more than, say, 1%, maybe 2% absolute max of their total trading capital on any single trade outcome. That preserves capital, lets them survive the inevitable losing streaks.
What else?
They also tend to have realistic expectations. They're not looking for overnight riches. They're aiming for steady, consistent growth over time. And they are meticulous record keepers. They continuously review performance, learn, adapt.
Okay, so to measure that performance and viability, what are the absolute essential metrics we need to track?
Right. There are a few critical numbers. Number one, profit factor. This is your gross profit divided by your gross loss. You absolutely must aim for a profit factor of at least 1.5.
Why 1.5 specifically? Seems high.
Because that extra 0.5, that 50 cents profit for every dollar lost in the back test, that often just covers your real-world costs, the spreads, the slippage, maybe small data fees, the VPS cost. If your back-tested profit factor is only, say, 1.1 or 1.2, once you factor in real-world friction, you're almost certainly going to be losing money live.
Got it. Buffer for reality. What else?
Second, you need to track the recovery factor. That basically measures how quickly your equity curve recovers after a drawdown. Higher is better, shows resilience. Third, the Sharpe ratio. This is key for risk-adjusted return. It tells you how much return you're getting for the level of risk or volatility you're taking on.
Okay, profit factor, recovery factor, Sharpe ratio, and the big one for downside protection.
That's your maximum drawdown, the largest peak-to-trough percentage drop in your account equity. Successful systematic traders work very hard to keep this metric below 20%. If your strategy is regularly experiencing drawdowns bigger than that, it's either fundamentally flawed or you're simply risking way too much per trade. It likely needs to be taken back to the drawing board or retired.
This is incredibly practical.
Okay,
Let's try and boil this down into an actionable plan. Maybe 6 steps for someone listening who's ready to implement this level of rigor.
Okay, 6 steps. Step 1, educate thoroughly. Seriously, read the foundational stuff. Ernest Chan's books on quantitative trading are excellent for the theory. But don't neglect the psychology. People like Brett Steenbarger write brilliantly about the mental discipline required. You need both.
Right. Step 2.
Start simple. Don't try to build some hyper-complex AI system from day one. Begin with a straightforward, understandable system, maybe a basic trend following strategy or a simple mean reversion setup, master the process of testing and implementation first.
Makes sense. Step 3.
Acquire quality data. Don't skim pure. Find reputable data vendors. Maybe start with free sources like HISdata just to learn. But for serious testing, you often need paid, clean, high-quality, multi-year data that covers all those market conditions we talked about.
Okay. Step 4 is the big one.
Step 4. Develop and test rigorously. This is non-negotiable. Follow that sequence religiously. In-sample optimization, rigorous out-of-sample testing, walk-forward analysis, and then that mandatory period of demo trading. Do not skip any of those stages.
Got it. Step 5.
Implement risk management before you start. Decide your position sizing rules. Are you using fixed, fractional, volatility adjusted? And crucially, set those maximum drawdown limits, your shutdown rules, before you place a single live trade. Write them down.
And finally, step 6.
Deploy, review, and adapt. Start live with small size. Use that VPS for stability. Keep a detailed trading journal, not just P&L, but why the trades were taken, how the system felt, any anomalies. And be prepared to make adjustments based on performance data, not emotion. Or, and this is key, if the market fundamentally changes like a real regime shift, not just a bad month, be prepared to retire the strategy entirely.
That leads perfectly into the wrap-up. It sounds like success really isn't about finding one magic bullet algorithm.
Not at all. It's about the combination. Robust strategy design, yes, but coupled with that unforgiving testing process. Sensible risk management, and maybe the hardest part, the psychological discipline to follow your own rules. It's a system, an end-to-end process.
We've covered a ton, from spotting stat arb to the math behind needing a 1.5 profit factor.
Yeah.
Let's leave our listeners with one final, maybe provocative thought that really hits home on that discipline point.
Okay. Imagine this. You've done everything right. Your strategy is robust, back-tested rigorously over years, survived walk forward, survived demo, you launch it live, but then the market changes, and it hits your predefined shutdown rule, your max drawdown limit 5 times in a row. The system is screaming, stop, something is broken, or the environment has changed. How do you find the psychological strength, the discipline, to actually retire that strategy, to accept the loss and move on, instead of overriding the rules based on hope or ego or fear of missing out? That moment, that decision to stick to the system, even when it means stopping something you poured effort into, that might just be the hardest, but also the most critical part of being a truly systematic trader.